Good evening, friends. It's my pleasure to warmly welcome you all to this live webinar on changes and issues in tax audit, organized by the Taxation Audit Quality Review Board of ICI, whose Vice Chairman is CA Pankaj Shah sir and Chairman is Anuj Goyal, CA Anuj Goyal sir. So now let me introduce CA Pankaj Shah sir, our Vice Chairman. He is a distinguished chartered accountant with nearly 2 decades of experience specializing in direct tax litigation, business restructuring in estates, and succession planning and valuation. With an exceptional blend of legal, financial, and business expertise, he has built a reputation as a trusted advisor and thought leader in the field. He holds multiple prestigious qualifications, namely a fellow chartered accountant, company secretary, BBA, LLB honors, insolvency professionals, registered valuer. CA Pankaj Shah currently serves as a Central Council member of ICAI, contributing actively through various standing and non-standing committees. He has delivered over 1,000 technical seminars across forum, earning acclaim for his exceptional communication and presentation skills. He has also authored numerous insightful articles in the ICI Journal and served as an editor of ITJ magazine, reinforcing his role as a respected voice in taxation and restructuring. His broad based knowledge enables him to provide holistic, forward thinking advice, making him a valued advisor to entrepreneur, corporate, family business, and professional alike. Now, let me welcome CA Pankaj Shah sir for opening remarks.
Very good morning, very good evening. Very respected Chairman of the Tax Audit Quality Review Board, Shri Anuj Goyal sir, under whose
Thank you, sir.
able
Thank you very much.
visionary leadership, we have selected more than 1,000 cases under Tax Audit Quality Review Board for review. Yes, friend, this through this webinar, at the outset, we would like to convey that Institute as a regulator is very well disseminating its function, especially by review of tax audit reports also. So, friends, tax audit. I always say tax audit is a national duty of chartered accountants. If chartered accountants are partner in nation building, it is because of these tax audits we are able to reach out to every each and every businessman, each and every fraternity. Friends, last year, as per statistics, around 38 lakh tax audits were filed. So we can imagine what kind of mammoth function this tax audit is. Under this, we should first see that tax audit is an audit. There is a 1994 Central Council decision which says that tax audit is firstly an audit. It is audit of general purpose financial statement. So therefore, before moving to clause number, all the clauses in 3CD, we should always keep into mind that tax audit is audit of books of accounts, whether they give true and fair view or not. So with this background, the tax audit is firstly an audit, and therefore we need to see whether the balance sheet and P&L gives a true and fair view or not. We should move ahead to the tax audit and its reporting clauses under 3CD. Friends, there is one more myth that 3CD is our report, but I would like to clarify here that 3CD is the report of the client and 3CB is our exclusive domain. So whenever there is a under reporting or something which is not reported by client in 3CD, we can report it in form number 3CB. These are some basic tenets which I made you aware. Friends, tax audit, it is a monopoly of chartered accountant. We all remember the decision of Supreme Court in T.D. Venkat Rao, which is now reiterated by the Select Committee when this Income Tax Act has been enacted. The Select Committee has also said that chartered accountants are rightly given monopoly in tax audit. No other person can be said as competent for tax audit as our chartered accountants, because auditing standards is something which is being taught to chartered accountants. Auditing standards, this makes us different. So friends, while doing any tax audit, we should go through auditing standards. Our leader Anuj Goyal sir, under his able leadership, Tax Audit Quality Review Board has come out with various publications. I would request you, all these publications are available full free of cost. Kindly go through these publications. These are available in PDF format. All our articles and audit staffs must have this for reference. We have very able speaker today, Pankaj Saraogi ji. So I would not say much on technical front. He will be dealing with things, but I heartily welcome you all in this the most important function of every chartered accountant. So, welcome to all. Welcome, Speaker Pankaj Saraogi ji and our chairman. Thank you very much for to MOC.
Now, let me introduce CA Dr. Anuj Goyal, sir, Chairman of TAQRP Board. He is a practicing chartered accountant and Central Council member of Institute of Chartered Accountant of India. He is one of the youngest Central Council member from Central Region. He has also served as a chairman of Ghaziabad chapter of the Institute of Company Secretaries of India and Institute of Cost Accountant of India. He has made a significant contribution to the profession with his extraordinary tenure of 19 years in the Central Council, 3 years in the Regional Council, and 6 years in the branch, including Chairman of the Central India Region Council, Chairman of various ICI Central Committees, Member of Additional Board, and so on. He is currently Chairman of Taxation Audit Quality Review Board and Committee for Members in Industry and Business, as well as the Deputy Convener of Publication and Series Directorate. He is a goal-oriented man having vast experience of over 30 years that is supported by various professional degree including CA, CS, CMA, CWA, LLB, MCOM, PhD, DISA and DIRM. He is a prominent figure in the profession and has shared knowledge as an examiner, paper writer and speaker on various topics and also as visiting faculty member of various institutions. He has also worked as an editor-in-chief and editor of various publications of professional interest. Now, let me welcome CA Dr. Anuj Goyal for his welcome address.
Very good evening, friends. I am really very happy that we are having our very prominent resource person and vice chairman of Taxes and Audit Quality Review Board, CA Pankaj Shah sir, who is really doing wonders for the cause of the profession. He is a great expert of the taxation, particularly for the appellate matters. So we are really fortunate that we are having CA Pankaj Shah ji and another Pankaj Sarogi ji, who is now chartered accountant and advocate, who is really doing good as the brand ambassador of the Institute of Chartered Accountants of India in the legal profession. So I welcome board Pankaj ji, and we are of course having our moderator, our master of ceremony, our anchor, CA Neha Bansal ji, who is a very prominent chartered accountant, and of course CA Sritika Arora ji, who is the secretary of Taxation Audit Quality Review Board, and Hani ji, the chartered accountant who is working with the Taxation Audit Quality Review Board, and CA Ali, and all other respected team members of the Taxation Audit Quality Review Board, and all our honorable uh, viewers, delegates who are with us, and all of us are very well aware that this tax audit is the exclusive area which a member of the Institute of Chartered Accountants of India has the exclusive right, and under the definition of the Accountant and Income Tax Act, only the chartered accountants are there. And friends, there is great expectations of the regulators, of the government, of the Ministry of Finance, of the CBDT, of the end users, from the members of the Institute of Chartered Accountants of India who are doing the tax function, who is doing the tax audit. We are very well aware that we have fought a lot to see that tax audit remains within the ambit of the members of the Institute of Chartered Accountants of India, and we of course deserve to have the exclusive right, exclusive power, and friends, there is always hue and cry, big hue and cry that as the time available for us after the last date of the filing income tax return, only 15 days are left. Only 14 days are left to complete the audit under tax audit. But I will request with all of you with folded hands that we chartered accountants are those professionals who have put their heart and soul. Then only we have become the chartered accountant. We may have studied 18 hours a day. Then only we have become, we have passed the toughest examination, have become the member of ICI. and we should not give any room to anybody to say, to communicate that the chartered accountants are not having sufficient strength, are not having sufficient capacity to undertake this tax audit within a given time frame, in spite of the fact that we are very well aware that there were a lot of problems as far as the utilities, etc., are there, whether it is filing of the income tax return or the tax audit. And one more thing which is there, that now for the non-corporate assessees, we are very well aware that a new format is there, and if that new format is not being followed by the auditee, then we have to give the disclosure. I will request all our honorable members of ICI that don't go in any unnecessary confusion. If the financial statements of the non-corporate assessees are not in the new format, we can very well give the disclosure, and sky is not going to fall. And you rest assured that we'll certainly see, we'll certainly ensure that nothing adverse reference is being taken if we are disclosing that a new format has not been followed by the non-corporate assessees. But we should try to see, we should put our 100% to see that how we can complete this audit process within the given time frame, and the most importantly, we should not give room to anybody. We should try to see that how the best of the quality can be ensured, and we are the best accounting professionals not only in our country but across the world, and we can really deliver the goods in the best possible way. Of course, Pankaj Sarogi ji is here. He will certainly discuss that what are the commonly found errors and how we can try to ensure that those errors can be avoided while giving our report under Income Tax Act. I will not be taking you further time, as we are very, very eager to hear our learned speaker, Pankaj Sarogi ji. I am really grateful, really indebted to Pankaj Saji, our Honorable Vice Chairman, and rightly said that we have taken this wonderful initiative to see that how the quality of the tax audit can be ensured. And this year, 1,000 big tax audit reports are to be quality reviewed by our empaneled tax audit quality reviewers. This is a very, very big challenge, very, very big task. But with the help and support of all of you, we will certainly see that how we can achieve this target, and can show to the world at last that the Institute of Chartered Accountants of India, Taxation and Audit Quality Review Board, is trying its level best to ensure the best of the quality of the audit under income tax. So thank you very much. Over to Neha Bansal, our honorable master of ceremony. Thank you very much.
Thank you, sir. Now let me introduce our speaker, sir, CA Pankaj Rogi, sir. He is CA turned advocate. He is also into litigation from assessment to Supreme Court, tax advisory and compliance. He is having 18 years of experience in direct tax laws. He is a 10th rank holder in CA final, and he is a member of institute since 2007. He did his graduation from SRCC and also hold diploma in indirect taxation. He is being special invitee of direct tax committees of ICI for the year 2018-19. He is an eminent speaker in seminar, workshop and training on direct tax organized by ICI, PSUs and corporates. Now, I would like to welcome CA Pankaj Sarogi sir for the technical session.
Thank you, Neha. First of all, would like to say that I'm highly honored and obliged with I will say our chairman of the Tax Audit Quality Review Board, CA Dr. Anuj Goyal ji.
Thank you. Thank you very
And
much.
being an Indian, मैं उनको एक क्या कहते हैं स्टेटमेंट देना चाहूंगा हिंदी में कि अनुज जी को उनके अनुज का नमस्कार.
नमस्कार.
Friends, Anuj अर्थात if I say the छोटा भाई. Then we have Vice Chairman Pankaj Sahaji, and as introduced by the CA Nehaji, that is he, quite expert in direct tax litigations, direct tax fields. तो पंकज साहा जी को एक पंकज का नमस्कार. The moderator of the session, CA Neha, Secretary of the Tax Audit Quality Review Board, Shrutika Abrai, and the other team members of the Tax Audit Quality Review Board, and the participants, the professional colleagues. Good evening. Friends, going towards the today's topic, that is changes and issues in tax audit. As said by Pankaj Saha sir and Anuj Goyal sir, that it has been established, it has been written that for the tax audit, the chartered accountants have the monopoly. But friends, when we have the monopoly, guided by the law, that comes with the responsibility also. And it is our responsibility that this particular monopoly continues over the decades. So that we have to take care of. Whenever we go for the tax audit, specifically that it has been said in this session only, that thousands of the tax audits are being reviewed by the Tax Audit Quality Review Board. So that is by our own committee, or we can say our own ICI. But obviously that review results into something negatives, something that we are not doing our work properly, may result into negatives in the future for us. It is very long back that we have monopoly over the audits. So coming to the towards the topic, friends, we will discuss first the changes in the tax audit. We'll have a detailed discussion where there are some technical changes are there. And after that, we will shift towards the issues in the tax audit. Friends, my approach will be that I'm not going to discuss kind of like clause by clause, starting from clause 1 and then clause 2. Whatever the relevant clauses are there as per my understanding, which impacts or which have effects over maximum tax audits we are doing, that I'm going to discuss first. And the balance clauses, if I talk about, if the time permits, we will shift to that. And in between, if you have a query, madam, what will be the system for the over the question and answers? Whether it will be visible to me if any participant is asking any question.
Sir, at the end we have kept 10 minutes for the Q&A session.
Okay.
So we will read question one by one, which are relevant ones, and then you can take up.
So that will be visible to me or not the questions, or you are going to...
If you want, I can share you the link.
Okay. So that will be shown here only on the Zoom platform or somewhere else?
Yes, actually that will not be sorted. So we will sort the relevant ones and
okay,
then
no
we
issues,
will ask.
no issues. Okay, no issues.
Okay, sir.
Okay.
Yeah.
So friends, if you have some questions regarding to the clauses we are going to discuss here, if you have some questions, you can post that. And definitely, I will try my best to have all maximum questions that we can discuss at the scheduled time. Let's share my PPT and discuss the changes first. I hope this is visible. Friends, tax audit. If we talk about like in the March 2025, there was a notification by which Form 3CD has been changed. Small amendments are there, one or two major amendments are there, which are effective from 1st of April 2025. Now, what does that mean, effective from 1st of April 2025? Friends, it does not mean that it is applicable for assessment year 25-26 and later assessment years. It means that if any audit, tax audit is being conducted on or after 1st of April 2025 in respect of any assessment year, these particular changes are applicable, and as an auditor, we have to make comments upon them. Like for example, it is quite possible there is a delay in tax audit because of some reasons on account of assessee or whatsoever the reasons. And for assessment year 24-25, tax audit is being conducted today. That is possible. Maybe on account of some mergers or amalgamation, it is quite possible that audit is being conducted from assessment year 23-24 or 24-25 today. Then these changes are applicable and we have to report. Yeah, obviously that we have to take care. It may be quite possible that a particular provision for which changes are being made in this particular form 3CD may not be applicable for that assessment year. In that case, we have to give a suitable observation, although this clause is applicable, but there was no, this section has no applicability in that particular year. Like, for example, if I talk about section 43, capital B, clause H, so that is quite possible. But if I talk about clause in respect of GST, although it is not changed, it was around like 4 or 5 years back, and I'm doing audit today, I have to make comment upon the GST, that clause number 44. So that we have to take care, but that will be very limited cases. Coming to small changes first, whether P&L clause number 12 includes profits assessable on presumptive basis, in that they have included section 44 BBC also, that is applicable in respect of business of operation of cruise ships in case of non-residents. So we have to report that. Again, a very limited applicability if I talk out. Friends, in that clause 12, that we have to take care of that profits included to be reported and not profits assessable. Like, for example, I am carrying two types of business, in which one business is eligible for section like 44 AD or maybe ADA or whatever. Now, if I'm maintaining the books of accounts, the profit of that particular business for which presumption section 44 AD is applicable is included in P&L account. And that profit may be rupees, for example, 10 lakhs, calculated on the basis of the revenues and expenses. But under section 44 AD, the 6% may result into 12 lakhs or maybe 8 lakhs. That is more than 10 lakhs or maybe less than 10 lakhs. But in that case, what we have to report, the profits included to be reported and not profits assessable. That means we have to identify the impact over the P&L account of that particular business for which presumptive section we are opting for. We are opting for, that assessee is opting for. So that we have to take care in respect of clause number 12. Clause number 19 subsections are no more relevant. So they have said that amounts admissible under sections omitted sections 32AC, 32AD, 35AC and 35CCB. They are no more applicable. To be reported, again, that what we have to take care in case of clause 19, amount debited to P&L account. And another thing what we have to report, or we have to certify, that amounts admissible under income tax law. Various sections are there, like donations to scientific research, maybe in-house scientific research, preliminary expenses if we talk about section 35D. So you have to certify two amounts. First amount is amount debited to P&L account. Second thing, which requires professional expertise, which requires application of mind, and which is that amounts admissible under income tax law. That we have to certify what is the amount which is admissible. That means we have to go through that particular provision. We should have a good knowledge regarding the judicial developments in respect of that section. Supporting vouchers and documents to substantiate that particular amount the assessee has incurred, and on that basis only we will be able to certify what is the amount admissible under that particular section. Friends, this is a small example on the basis of which I can say that tax audit is not collation of facts and figures. It's truly an audit. We have to certify. We have to check on the basis of the law, judicial developments, rules, circulars, that particular amount is admissible or not, that particular amount is required to be reported as part of that particular clause or not. So friends, when we talk about, like, we know that there are two types of form, 3CA and 3CB. In 3CB, we are doing two things. First of all, we are auditing the financials, books of accounts. And second thing, we are certifying form number 3CD. In case of 3CA, we are certifying form 3CD. We are not doing audit of books of accounts. Even though if we are certifying, friends, it's audit. Certifying means that we have accounted for each and everything which is applicable of particular that amount which is being reported as a part of a particular clause. Clause 21A, new row added. Friends, if we talk about the clause 21, it talks about expenditures in the nature of like capital expenditure, personal expenditure, which are debited to P&L account. In that, they have added one new row, which is on account of development by finance number 2 Act 2024. We all know there is an explanation as part of section 37(1), which says that if you are making any expenditure which results into violation of any law by the person receiving that amount, that is not allowable at business expense. That was introduced way before, and for that purpose, the amendments were made in the last year itself in Form 3CD. If I talk about another aspect which is there in already in clause 21, that if I'm making any payment which is in result of any offense of any law, violation of any law in the nature of penalty, fine, that is to be reported as part of clause number 21. And by virtue of section 37, these amounts are not allowable as expense. The question which arose, like for example, I made a particular violation, and for violation, penalty or fee, whatever may be levied, that may be, for example, rupees 2 crores. But I approach that particular honorable court or the honorable party to settle that particular contravention, particular violation. And for that settlement, I am incurring a particular amount. Whether that will be treated as part of earlier clauses, that is expenditure in respect of any violation of law, offense of any law. That was the question. That's why they introduced a particular provision in the section 37(1) itself, that expenditure incurred to settle proceedings, expenditure incurred to settle proceedings initiated in relation to contravention under such law as notified by the central government. Friends, please remember this particular settle proceedings, expenditure incurred to settle proceedings will be disallowed, is required to be reported only in case of such laws which are notified by the central government. Otherwise, this particular clause or explanation is not applicable. But when we talk about the other clauses which says that expenditure incurred in violation or offense of any law, that includes all type of laws, is not restricted to particular or selected laws. Now, in respect of this particular amendment, only 4 laws has been notified till date. Only 4 laws. That is the Securities and Exchange Board of India Act, the Securities Contract Regulation Act, the Depositories Act, and the Competition Act. That means if there is a settlement proceedings in respect of any other law, this is not covered up by this particular amendment at all. Another thing, that this particular 4 laws have been notified on 23rd of April 2025. That means for financial year 24-25, that is assessment year 25-26, the year for which we are conducting audits as on date, in my personal opinion and interpretation, this amendment is not applicable, because up to 31st of March 2025, no law has been notified under this clause. So we can suitably give an observation as part of clause number 3 or clause number 5 of form 3CA or 3CB, as the case may be, that this clause is not applicable as no law was notified till 31st of March 2025. Clause number 28 and 29 omitted. They were in reference of section 56 to 7A and 56 to 7B. The 56 to 7A was in respect of receipt of shares for price lower than fair market value. This particular clause has been merged with section 56 to 10, that has been omitted. 56 to 7B was in relation to issue of fresh shares, which is no more applicable. That's why this has been omitted. Clause 31, that is in respect of loans, section 269 SS, section 269 T, 269 ST, that we have to report, we have to certify whether any loan has been taken otherwise than account pay check or bank drafts or electronic clearing system, whether repayment is there or not or whatsoever. In that, we have to report that by which particular mode amounts have been received or repaid. Now, they have provided the drop down menu. We have to select the number 1, 2, 3, and 1, 2, 3 denotes these particular various options by which amount may have been received or may have been repaid. That is cash payment, cash receipt payment through non-account pay check, transfer of asset, transfer of liability, conversion of assets, journal entry, any other mode. So that is again, if we talk about the clerical amendment for the purpose of clarification in the tax audit itself. Coming to clause number 36B, and then we will move towards the major amendment by this particular notification of March 2025. Whether the assessee has received any amount for buyback of shares as referred to in subclause F of clause 22 of section 2, that is yes or no. If yes, please furnish the following details: amount received in rupees, cost of acquisition of shares bought back. When this particular amendment, which was there by finance number 2 of 2024, was with effect from 1st of October 2024. That simply says that if there is a buyback owner after 1st of October 24, then whatever the amount is received by the assessee on account of buyback, the shareholder, that will be taxable as part of dividend under head income from other sources, and the gross amount is taxable. And whatever the cost has been incurred by the shareholder for acquiring the shares shall be allowed as cost of acquisition under head capital gains. Under head capital gains, in which full value of consideration will be nil. Other way around, I can say that whatever the cost was incurred, that will be allowed as long-term or short-term capital loss under head capital gains. This particular amount is treated as part of income from other sources. And this loss, whether long-term or short-term capital loss, we all know is not allowed to be set off with income from other sources. Second thing, this income from other sources is taxable at applicable rates. Long-term is taxable at 12.5%. Short-term maybe 20%, maybe applicable rates. So if you are incurring long-term or short-term loss, the ultimate tax saving because of set-off will be restricted to 12.5% or 20% in maximum cases, but this dividend is taxable as applicable rates. Friends, please remember the date. If there is any buyback before 1st of October 24, the resulting profits are exempt in the hands of shareholder. Company is required to pay tax on distributed profits. So for this particular provision, you have to check out whether assessee has received any consideration, any amount because of buyback on or after 1st of October 24 or not. Coming to the major one, that is clause number 22. If I talk about the clause of the day or the clause of the year, friends, this award can be given to this particular clause number 21 as the award of the year. Wherever we go, and if there is a discussions regarding tax audit, the first of all discussion is regarding the clause number 22. That what amount is to be reported, how to find out that particular amount, what is our responsibility, which documents to be collated, everything. Friends, if I talk about Roman number 1, that was earlier also, amount of interest inadmissible under section 23 of the Micro, Small and Medium Enterprise Development Act 2006, that is MSMED Act. Friends, this amount is reported only if it is debited to P&L account. If the assessee is not providing interest as an expense in the books of accounts, friends, no amount is required to be reported as part of clause number 22 Roman 1. A suitable observation in this regard is required to be reported as part of clause number 3 or 5 of form number 3C or 3CB, that the assessee is not providing interest under section 23 of the MSME Act. Please remember, this amount is required to be reported only if debited to P&L account, otherwise not. And this interest, if I talk about, is applicable for all type of enterprises, that whether it is micro, whether it is small or medium. Now coming to clause number 22, Roman 2 and 3. Friends, we will go by word and we will find out the fine aspects of that clause number 22. Total amount required to be paid to a micro or small enterprise as referred to in section 15 of the MSMED Act during the previous year. Friends, we all know that section 43BH, which was introduced with effect from, if I talk about financial year 23-24, this is the second year we are doing audit. And if you remember, the award of the year for the last year was to section 43BH. And this time also directly or indirectly, it is for 243BH only, because clause 22 is in respect of section 43BH only. What we have to state, the total amount required to be paid to a micro or small enterprise, we all know that section 43BH is applicable if any amount is payable to a micro or small. Medium enterprises are not covered up by section 43BH. And that's why they have written micro or small only. And what is to be reported? Total amount. Friends, it's not like section 43B clauses A to F recording or A to G recording. I think clause number 26, that talks about section 43B. Friends, we have a policy which we are following from very long back, that in section 43B, it talks about the amount required, which are covered up by section 43BA or BB or BC, whatever. And we report amounts outstanding as on 31st of March only, and not the gross amount which was required to be paid throughout the year. But here the language is very clear that you have to report total amount which was required to be paid to a micro or small enterprise. That means you cannot report the amount which is outstanding as on 31st of March, but you have to report the amounts which was payable throughout the year. But provided it is covered up by micro or small enterprise, payable to micro or small, whether paid or not, it does not talk about. And during the previous year. That means if any prior outstandings are there, are not covered up by Roman 2. Coming to Roman 3, then we will discuss again various aspects which is to be reported where, how these are reconciling, whether we have to reconcile or not. Of amount referred to in 2 above, amount paid up to time given under section 15 of the MSMED Act. What talk about 3A? That says out of Roman number 2, report the amount which was paid within the time given under section 15 of the MSMED Act. And we all know that under the MSMED Act, the time for payment is 15 days or 45 days as the case may be. I'm not going into depth of that particular aspect. When 15 days is applicable, when 45 days is applicable, from which date it is applicable. That is a separate aspect of discussion. That says paid up to time given under section 15. But if you go by section 43BH, it says if the amount is not paid within 15 days or 45 days as the case may be, then it will be allowed in the year in which it is actually paid. Now it is quite possible that there is an amount of May 2024 of which 15 days or 45 days as the case may be were expiring on, like for example, I'm just assuming a date 14th of June 24, but actual payment was made in December 2024. Now this amount is not paid within 15 days or 45 days, but within the year. Now this amount is part of clause number 2 because it is part of total amount required to be paid to a micro small, but it is not part of 3A because it was not paid within time. The time means as per section 15 of the MSMED Act. Although it is allowable as part of financial year 24-25, there is no disallowance by virtue of section 43BH. Still, it will not form part of 3A. Now, will it form part of 3B? Let's check out the language of the 3B. Not paid up to time given under section 15 of the MSMED Act and inadmissible for the previous year. Now, if I talk about 3B, it says not paid up. If you have not paid within the time given, that is 15 days or 45 days, and inadmissible. But clause 3B requires the reporting only if it is inadmissible. That means in clause 3B, this amount will also not be reported. This particular example we are talking about. This May 2024 expense is part of column number 2, but it is not part of column number 3A. It is not part of column number 3B. If we talk about 3B, in this, the only amounts which are possible, that is outstanding as on 31st of March 2025. The possible, out of these outstanding amounts, if any amount has been paid within 15 days or 45 days as per section 15 of the MSMED Act, which may be on or after 1st of April 25, is again not part of clause number B. That means out of 31st of March 2025, you have to find out two things which are paid within time and which are not paid within time. I'm talking about outstanding as on 31st of March 2025. So this is not part of clause number 3B. This is part of clause number 3B. Now, one principle we can draw from particular this interpretation that 3A plus 3B is not required to be equal to column number 2. Friends, you do not have to check out whether column number 2 is coming equal to 3A plus 3B. Please remember that. I'm receiving queries and almost daily whether clause number 3A plus 3B should be equal to clause number 2. It is not required. Clause number 2 is independent. Clause number 3A and 3B are independent. Both are not required to be equal. In practical parlance, if I talk about clause number 3A plus 3B will be equal to or will be less than clause number 2. In my viewpoint, in my checking, it cannot be more than clause number 2. Now, one more thing. Now, it is quite possible there was a capital expense during the year. Now, for me, it is capital expense. And for the seller, supplier, it may be a general revenue in which he is dealing with. Now, it is quite possible the seller who is providing me this particular capital asset for which I incur my capital expense may be covered up by the MSMED Act, that is 43BH. Like for example, I have purchased a particular printer costing rupees 15,000. All other conditions are being fulfilled. Now, whether this capital expense is required to be as part of clause number 2, although it is not part of P&L account. Yes, friends. Because if we go by the clause number 2, it does not differentiate between whether it is revenue expense or capital expense. Whether it will be part of clause number 3A, provided it is paid within time. Yes, it will be part of 3A, provided it is paid within time. Because again, if I talk about clause number 3A, it does not differentiate between revenue or capital expense. Will it be part of clause number 3B if not paid within time and outstanding as on 31st of March 25? No. Reason being, friends, the first part of clause number 3B is being fulfilled, that is not paid up to time given under section 15. But another part of clause 3B is that it is inadmissible. And we all know that section 43B is not applicable over capital expenditure. It is applicable only over revenue expenditure. So capital expense will become part of clause number 2, will become part of clause number 3A, but it cannot be part of clause number 3B. In clause number 3B, in any case, the amount which is required to be reported is only that amount which is required to be disallowed as part of 43BH. I hope, friends, I am clear with this particular aspect up till now. This particular 2 questions I have discussed. Coming to clause number 26, in which there is a corresponding change because of the change in clause number 22. And that is quite interesting. And we have to take care not only for this particular year, but for every year if I talk about in the future. Friends, clause number 26 have 2 parts, capital A and capital B. Capital A says, pre-existing on the first day of the previous year, but was not allowable in the assessment of any preceding previous year and was. There are again 2 parts, was paid during the year, was not paid during the year. This is in respect of 43 capital B. So first of all, 26 capital A talks about those expenses which were disallowed in prior years in respect of 43B, A, B, whatever, and which were paid during the year, which were not paid during the year. If paid during the year, will be allowed as an expense. Not paid, it will not be allowed as an expense at all. 26B is in respect of expenditure incurred during the previous year, which are covered up by section 43B and paid during the year, paid on or before due date of ITR, and not paid on or before due date of ITR. The most interesting part is that if I talk about 26 capital A, 43BH is part of this clause 26 capital A. But if I talk about 26B, you will notice that in the drop down menu, 43BH is not part of this clause. This is in respect of financial year 24-25. That is assessment year 25-26. This is in respect of financial year 23 or before. Now, what does that mean? I will just take a small two examples and you will understand that in which clause what is to be reported for current year, for the past year, for the upcoming year. That we have to take care, friends. That is very serious. If I talk about wrong reportings, will not only impact our audit quality, but also may result into the additions under section 143(1) at the time of processing. Like, for example, in financial year 23-24, there was disallowance under section 43BH of rupees 50 lakhs, out of which 30 lakhs paid during financial year 24-25, 20 lakh not paid during financial year 24-25. Now, for financial year 24-25, there is disallowance under section 43BH of rupees 60 lakhs. Quite possible. Out of which 37 lakh paid financial year 25-26. 23 lakh not paid. Plus, out of this 20 lakh paid in financial year 25-26. Now, I have to fill up or I have to certify the form number 3CD of financial year 24-25. Financial year 24-25 form 3CD. Now, if I talk about clause number 22, 3B, there will be reporting of 60 lakhs. There will be reporting of 60 lakhs. Now, if I talk about clause number 26, capital A, friends, in this, if we talk about, there will be reporting of 50 lakh, out of which I will provide two breakups, 30 lakhs and then 20 lakh. This is which was disallowed in prior years, but was paid during the year or not paid during the year, 30 lakh and 20 lakh. If I talk about 26B, there will be no reporting at all. No reporting. Because 43BH disallowance is covered up by 60 this 22(3)B and not covered up by 26B. Similarly, if I go to financial year 25-26 form 3CD, if I talk about clause number 22(3)B, that will be in respect of any disallowance. If it is in relation to 25-26, I'm assuming it to be nil. Now, this 20 lakh rupees and this 37 lakh rupees, this 23 lakh rupees will be part of 26 capital A, in which there will be amount of total 80 lakh rupees, in which there will be two parts, 37 plus 20, and another part which was not paid, 23 lakhs. So, friends, if we talk about the allowance under section 43BH of the prior years, this is part of clause number 26 capital A. But if I talk about disallowance of expenditure incurred during the current financial year for which I am doing the audit, the disallowance is reported to be as part of clause number 22. So, this particular aspect we have to take care if we go by the ITR forms. In ITR forms, it is not that 43BH is to be reported separately. It is made part of schedule other information, section 43B, clause number A to H, whether it is allowance or disallowance. So this small thing you have to take care, that 26A versus 26B. I hope, friends, I am clear this particular aspect. Coming to that issues day to day, Friends, this I tried to compile on the basis of two aspects: the queries I received from the various professionals, and also on the basis of the observations made by the Tax Audit Quality Review Board from time to time. Friends, if I'm not wrong, there is a publication of approximate 60 pages by the Tax Audit Quality Review Board around 2 or 3 years back. And I found it to be very useful. When that talks about the common mistakes that we are doing while certifying the tax audit reports, or you can say the mistakes committed by the assessees while compiling the figures for the purpose of various clauses. Friends, these are the basic aspects we all know. I'm not going to cover up that. This is just to create a theme for the discussions that who is liable businessman. We all know that turnover is greater than 1 crore, but tax audit is not applicable if turnover is up to 10 crores. If the receipts in cash up to 5% of total receipts, payment in cash up to 5% of total payments. I have used the basic terminology, not going into the depth of the same. And this particular provision is applicable for all type of assessees. It is not only for company. We can say that only for company or only for individual. It is not so. Receipts, friends, if we talk about the definitions, there is a definition language of the, you can say the definition varies from act to ITR form 3. Receipts includes, if we go by the act, the language says the aggregate of all amounts received, including amount received for sales, turnover, or gross receipts during the previous year in cash does not exceed 5% of the said amount. But if you go by the ITR form 3, it says whether aggregate of all amounts received, including amount received for sales, turnover, gross receipts, or on capital account. And I think this is covered up by this particular terminology, all amounts, like capital contributions, loans, etc. during the previous year in cash and non-account paycheck does not exceed 5% of the said amount. Similarly, the payments, friends, contra entries, in my opinion, the contra entries are not part of even receipts, not part of payments. So whenever you have to check about the 5% limit, you have to exclude the contra entries from both the sides, receipts and payments. Friends, with effect from assessment year 21-22, they provided a proviso that provided further that for the purpose of this clause, the payment or receipt, as the case may be by a check drawn on a bank or by a bank draft, which is not account pay, shall be deemed to be the payment or receipt as the case may be in cash. Now, for the purpose of determination of this 5% limit, the payments received or payments made which are not account pay by check or draft which are not account pay shall be deemed to be that payment or received in cash, but only for the limited purpose of determining whether audit is applicable or not. Now, the question arises, who has to decide this? Friends, we all know that there is a provision, clause number 31, in respect of section 269 SS or 269 ST. And I have noticed that maximum professionals we report that as part of observations that assessee is not in possession of necessary evidence to find out whether the loans have been received or loans have been repaid through account pay check or not. Now, when this particular information is not available, turnover is between 1 CR to 10 CR, then how to decide whether audit is applicable or not? Now, who has to decide? Friends, obviously for the audit, the assessee has to approach the auditor. But in practical life, the assessee asks us only कि sir, audit applicable है या नहीं है? Guide me. Now, obviously, the information is not available. Friends, in that case, what is my personal view? That we should have a letter from the management that necessary evidence is not in possession. But still, we request you to go for the tax audit so as to avoid the consequences of non-audit. Now, in that again, management letter in respect of amounts below 2 lakhs, it should be provided. The reason that if the payments or receipts are more than 2 lakhs, we all know the penalties are there. In case of loans amount more than 20,000, again penalties are there. So that is a very serious issue. And friends, we have to rely upon management representation letter. Otherwise, we have no option whether to conduct audit or not. And for this purpose, we can give a suitable observation as part of Form 3CA or 3CB. Now, it is quite possible when there is not in possession and we are doing audit or assessee is requesting us to go for the audit. In that case, the department may take a plea That means the amounts received or amounts paid are otherwise an account paid check. And in that case, the department may apply section 40A3, section 216 SS, ST, or whatever. For this purpose, I expect that there should be some clarification either by the CBDT or by the ICI that how the chartered accountant should approach in this particular aspect. Coming to that, section 44AD. Now, friends, who is liable for audit? We all know that there are various clauses if I talk about. Who is liable for audit? Turnover greater than 1 CR, 10 CR, profession case, receipts greater than 50 lakh, 75 lakh, plus cash involvement we have to check. Then we have section 44 AD. Then we have 44 ADA, which are applicable at large I'm talking about. Now coming to section 44 AD, if any assessing having margin less than 6% or 8% as the case may be, whether audit is required, friends, it is notes. I'm receiving queries almost on the daily basis that the profit margin is less than 6%, whether we have to go for audit. Friends, it is not so. The section 44 AD read with section 44 AB simply says that if in the last 5 years the assessee has opted for 44 AD, last 5 years means in any of the last 5 years, and in this particular year he is not opting for 44 AD, he wants to opt out although he is eligible. In that case, he is required to get books of accounts audited for this year as well as for next 5 years. As well as for next 5 years. Like for example, any person from financial year 67 to financial year 23-24 is declaring income under section 44 AD. Now in financial year 24-25, although he is eligible for 44 AD, but because of lower profit margin, he do not want to go for 44 AD return. He wants to go for normal provisions. In that case, tax audit is applicable. Plus for next 5 years. Now, what does that mean? Now, for example, if a particular person is having turnover of, for example, 90 lakhs. In financial year 23-24, he prepared books of accounts, followed normal provisions, and filed ITR 3. And having margin of greater than 8% case 1, less than 6% case 2. Friends, if this assessee is maintaining books of accounts, I'm assuming that prior to financial year 23-24, there was no 44 AD, there was no business. I'm assuming. Friends, in that case, audit is not required for financial year 23-24. No audit. What about financial year 24-25? Turnover again 90 lakhs. Profit margin less than 6%. No audit. Friends, if for every year assessee is maintaining books of accounts following normal provisions of the Act and he has not opted for 44 AD at all, audit is not required. Even if his turnover is more than 1 CR, that is more than 1 CR but up to 3 CR, and payments and receipts are within banking channels, cash payments are within 5%, and if he is maintaining normal books of accounts and margin comes to below 6%, but even though tax audit is not required. Tax audit in case of businessman is required only in case in the last 5 years, if the assessee has filed return under section 44 AD. Otherwise not. And in that case, 6 years audit will be required. And for next total 6 years, assessee will not be eligible for 44 AD at all. But if you are maintaining books of accounts, declaring normal profit from very beginning, friends, because of by virtue of 44 AD, by virtue of profit margin less than 6% or 8%, audit is not required at all. Now, it may be case that in financial year 24-25, the assessee is opting out of 44AD by virtue of turnover more than 3 CR. It is quite possible. It is opting out of 44AD by virtue of the provision that cash involvement is more than 5% and turnover is between 1 CR to 3 CR. 2 CR to 3 CR. Now, in that case, he is not eligible for 44AD at all. He is not opting out. But by virtue of that particular section 44AD, the 44AD is not at all allowed. Now, in that case, in my opinion, audit is not applicable. And in next year, he can continue with again 44AD provided all conditions are fulfilled. Professional, we all know 50 lakhs or 75 lakh, two limits are there. So in case of professionals, if I talk about, friends, every year is independent. If profit margin is less than 50% and the assessee wants to pay the tax on the actual margin, in that case, tax audit is applicable. In case of professionals, we have not to check out what would happen in the next last 5 years or last year or whatever. Every year is independent whether audit is required or not. When this particular aspect I'm ignoring, if any person having any query that he can ask in this particular aspect, coming to further provisions. Friends, documents to attach. And that is quite crucial. This is not part of clause if I talk about clause number 1 to 44 or whatever. Friends, with the tax audit report, the first and the foremost document is required to be attached is the financials. That is balance sheet and profit and loss account. I have seen many cases where friends, the financials which are attached which are that we can say one pager balance sheet and one pager P&L. No schedule, no notes to accounts. Further, this one pager, one balance sheet, or maybe with schedule or accounts is attached as PDF with SD below that. No actual signature of assessee or the auditor. Friends, in my opinion, this is totally wrong. The balance sheet and P&L must be attached with the schedule and notes to accounts. And in case of 3CA, the audit report of the auditor, that is a statutory audit, maybe under the Companies Act or maybe the LLP Act, that is also supposed to be attached along with form number 3CD. Friend, this particular SD, although in my personal opinion, it is not advisable. The duly signed and scanned copy must be attached. But in any case, if we talk about when the attachments are there, post the attachment, there is a digital signature of assessee as well as auditor. But friends, where there are required to be that financials are required to be signed by two or more persons on behalf of the auditee, on behalf of the assessee, it is my humble request and advice that SD copy should not be attached. It must be scanned copy because digital signature is there of one of the director and not two directors in case of uploading of tax audit reports. Single page, I do not think so it is allowed at all. Although I have not heard any case the department is taking action in that particular aspect, but still it is not expected that single page balance sheet and P&L is to be attached. The full set need to be attached along with the schedules and notes to accounts. Revision of tax audit reports. Again, that is very quite crucial one. Can we revise the tax audit reports? Yes. No issues in that. But there must be circumstances, reasons on account of which tax audit reports can be revised. If you talk about the circumstances, the two circumstances are provided as part of Rule 6G of income tax rules even itself. Now, it is quite possible that tax audit is concluded by 30th of September, but ITR is being filed by 31st of October. And as per Section 40, Clause A regarding the TDS or 43B, Clauses A to F, A to G, friends, the expenditure is allowed if TDS is deposited by due date of ITR, or 43B if the payment is made up to due date of ITR. Now, if the payments in respect of financial year 24-25 are paid in the month of October 2025, whether it is an allowable expense, yes, no disallowance is required. But if we talk about the tax audit, this amount would be forming part of the disallowances. because up to the date of the audit, the payment was not actually made. Now, in that case, the audit is permissible. In my opinion, in that case, assessee should approach the auditor for mandatory revision. Otherwise, obviously, the consequences will be followed by the assessee because there will be a disallowance. And in that case, it need to be proved to the AO that actual payments have been made. Friends, any other matter, if there are circumstances are such that a revision is required, that maybe like, for example, mergers, it may be quite possible revision of accounts because of some technical grounds after the statutory audit, even after the adoption of the financials by the AGM. The circumstances may be possible. But in any case, the reasons for revision must be stated by the auditor as part of Form 3C or 3CB. Friends, separate UDIN is required to be generated for this certification. The old UDIN will not be applicable for revised tax audit report. Now, the question arises whether the revision of tax audit must be by the same auditor who did the first tax audit. Friends, if I go by the guidance note 2025, it says yes. Even my personal view is that it must be audited by the same tax auditor. Unless and until there are such circumstances when the tax audit, the revised tax audit is not possible by the first auditor at all. Turnover, GST to include or not discussing at this particular moment. Difference in opinion. Now, friends, I have seen many cases. Then in the Form 3CD, the amounts are reported relying upon various judgments. And judgments may be of the level of the tribunal, maybe the Honorable High Court or maybe the Honorable Supreme Court. First of all, as an auditor, can I rely upon particular judgments? That is a question. Now, assessee wants to rely upon those particular judgments, and on that basis, he's providing form number 3CD, the particulars in form number 3CD. And as an auditor, I have difference in opinion whether this particular expense is allowable or not, disallowable or not. Friends, we all know that the particulars to be furnished in the form 3CD is the responsibility of the assessee and not of the auditor. Audit is required to certify. Whatever we have to state as part of form 3C or 3CB. What the guidance note says in this particular case, he can rely upon judicial pronouncements while taking any particular view about inclusion or exclusion of any items in the particulars to be furnished under any of the clauses in specified form number 3CD. This is in respect of assessee. Assessee can rely upon judgments, no issues in that. If there is a conflict of judicial opinion on any particular issue, he may refer to the view which has been followed while giving the particulars under any specified form. Now, it is quite possible that differential judgments are there, different judicial opinion is there. So, friends, he can go by the view which is favorable to him. So, from the perspective of assessee, there is no problem if he rely upon that particular judgments and accordingly provide the particulars. Now, as an auditor, if there is any difference in the opinion of the tax auditor and that of the assessee in respect of any information furnished in form number 3CD by the assessee, the tax auditor may consider stating both the viewpoints and also the relevant information related to matter in his report, that is either 3CA or 3CB, in order to enable the tax authority to take a decision in the matter. Friends, practically I have seen cases where the tax auditor fills the form number 3CD. Now, if the form 3CD is being filled up relying on a particular judgment, friends, it can be filled up. But this should be, in my opinion, reported as part of Form 3C or 3CB, that relying upon this judgment, this particular benefit or particular figures have been reported, otherwise figure would have been so. So that we have to take care as an auditor. Coming to clause number 8, that is relevant clauses of 44AB. Clause number 8 says that you have to select from the drop-down menu option that under which particular clause this tax audit is being conducted or is applicable. Now, there is a 144ABA. First option, proviso where aggregate cash receipts and cash payments of business exceeding specified limits. Then again 44ABA, which says total sales or turnover or gross receipts of business exceeding specified limits. I'm limiting my discussion as of now up to these two clauses only. There are two situations. Turnover is greater than 10 crore. Second is turnover is greater than 1 crore, but cash involvement is also greater than 5%. Now, in which case, which particular clause need to be selected? Now, in this case, I think this is need to be selected, and in this case, this one. Total sales, turnover, gross receipts of business exceeding specified limits. Friends, because this particular first drop down option is very clear that this is need to be selected where the cash receipts and cash payments exceed specified limits. So that means in case turnover is more than 10 CR, this particular clause is need to be selected. Now, in case of ITR also, if you see, in case tax audit is applicable, in ITR also it is to be specified why tax audit is required. That is part of ITR. Clauses in ITR. There are three options are there. In ITR, there are not multiple options like 44AB or like tax audit report. First one is sales, turnover or gross receipts exceeds the specified limits. This is in respect of presumptive that we will discuss separately or others. Now the question arises if turnover is greater than 10 CR. Another example, turnover is greater than 1 CR plus cash greater than 5%. Now in which case what is need to be selected? Friends, if I talk about this particular language, in my opinion, greater than 10 crore will be covered up by this, and this particular aspect should be covered up by this. And I think both tax audit report and Form 3CD must sync in this particular aspect. Now there is clause E, when provision of section 44 AD4 are applicable, which we have discussed little while. Then again, there is a one more option, third proviso to section 44 AB, that is audited under any other law. Now, in case of Form 3CB, what we are going to select? Either this one, or this one, or this one, as the case may be. In case of 3CA, now friends, tax audit is applicable not because of the reason that the books of accounts are already audited under any other law. Even in 3CA, if I talk about the tax audit is applicable by virtue of either this one, or this one, or this one. Now, what is need to be selected in this case? In my opinion, in Form 3CA, what we have to select this one. Because it is provided specifically this particular proviso. Otherwise, it is totally redundant. Now, the question arises, if we are selecting third proviso, whether we have communicated that why actually tax audit was required. By virtue of the turnover is more than 1 CR, or by virtue of turnover is more than 10 CR, or by virtue of section 4484. No. Friends, in case of 3CA, you have to select two options. And that is permitted by tax audit utility. And what should be the first option? Friends, why this question is important, that what should be the first question? That it is important because when we are generating UDIN, friends, in that case, we can select only one option. In case of UDIN, we cannot select multiple options. Now, what should be the first option? That first option must be this one. And second option will be from these three. So please remember, in case of number Form 3CA, you have to select two options. That is third proviso to section 44AB plus one more. And in case of UDIN, you are going to select this one only. This is important parts, friends, which we are lacking. I have seen in many cases that in case of Form 3CA, either of these three is not being selected at all. Only third proviso to section 44AB is selected. That is not clear-cut communication why tax audit, why section 44AB was applicable at all. This I have discussed in perspective of business. Same interpretation will be in case of professionals also. Friends, if you talk about, like, for example, this is a screenshot of the utility. I have selected one clause and still there is a button with add details and it is quite active. You can select multiple options in clause number 8. Please take care of that. Clause number 8, capital A. Taxation under section 115 BA, etc. Now, in case of talk about the companies, friends, we all know that if they have to go for section 115 BAA, they need to file form number 10 IC. 115 ABC is automatically applicable. You have to opt out, then you have to file form number 10 IEA. Still, if I talk about clause number 8A, there is a flaw with the language. It says whether the assessee has opted for taxation under section 115 BAC. When that creates the confusion, in my opinion, this is to be selected yes only when the assessee opt outs of section 115 BAC and not word for opted for. Because now the 115 BAC is a default regime. So this should be selected yes whenever you opt out of section 115 BAC by filing form number 10 IEA. Now, what is the responsibility? Like, for example, if I talk about form number 10 IEA or 10 IC, is required to be filed on or before due date of ITR. That is 31st of October. But tax audit is required to be certified to be filed by 30th of September. Now, it is quite possible the assessee may be going to file form number 10 IEA in the month of October 2025. Now, friends, we have to go by the facts which are available on the date of certification. We cannot go for the futuristic positions. In case the assessee provides that I'm going for the old regime, kindly certify. So you have to obtain MRL in case form number 10IA has not been filed by the assessee. There is no other option. And if form number 10IA is not filed but still is going for the old regime, kindly provide this particular aspect as part of observations. Accounting ratios 222. I'm not going into that. Friends, deductions under chapter 6A. Although if I talk about it is more or less applicable only in case of old regime. In case of new regime, very limited deductions are allowed. But one thing you have to remember that chapter 6A deductions are to be provided as part of clause number 33 only if they are part of books of accounts which you are auditing. Friends, in case of individuals, in case of HUF, there are two books of accounts. One is meant for business, one is meant for personal transactions. If deductions are not through bank accounts meant for business, if deductions are not routed through P&L account or balance sheet of the business, friends, we have not to certify at all. It should not form part of clause 33 at all. I receive queries in case the deductions are not provided part of clause 33. There will be disallowance while processing of ITR under section 143(1). It is not so. GST, brought forward unabsorbed depreciation or loss. Friends, in this case, we have to provide the brought forward losses, brought forward depreciation. In that respect, Tax Audit Quality Review Board has an observation that section under which order passed and date of orders are not being reported. It is quite possible for a particular year, till date 143 processing has been done. There may be 143.3, there may be 147. So whatever the latest is available on the date of certification, we have to provide for, we have to provide under which order passed and date of order. If we are not reporting, then obviously that is not particular audit. And for that purpose, we need to check compliance of section 79 also, that the shareholding is with the common shareholder, all shareholders only. And for every year, we may need to check separately. We must have that particular list of shareholders for every 31st of March. Loans, deposits, acceptances or repayment. Clause 31. Then this is Tax Audit Quality Review Board observation that consolidated figures are reported for multiple parties. Then this is just to save the time, but this is not audit. If a particular person has borrowed funds from multiple persons, every person details are required to be reported as part of clause 31. By putting single PAN number and whatever, it is not permissible at all. For observations, general language used without modifying as per facts. Whatever is proposed in the guidance note that we are copying pasting, that is again not permissible. Friends, SANVAT credit, whether in clause number 27, the question arises whether the GST is required to be reported or not. This is a difference because in case of if we talk about the utility, there is a different language. But if we talk about the notified form 3CD, it does not talk about ITC at all. It talks about only SANVAT credit. So you have to decide whether you want to follow the notified form or you want to follow the utility. In case if you want to follow the notified form, but obviously we have no other option but to fill the utility, in that case we must get suitable observation that we relied upon the notified form. And in clause number 27, clause subclause A, the only the SANVAT is reported and not GST at all. Even as per guidance note, friends, it is very clear in clause number 27A, GST is not required to be reported because SANVAT is still applicable on selected products. So only if your assessee is dealing in those products, clause 27 is applicable. Otherwise, nothing is required to be reported. But if we are using the utility, obviously we are certifying this particular language, so we must get suitable observation as part of form number 3CA or 3CB. Friends, section 41 incomes. That means if any recovery is there, there is remission of any liability or whatever. Friends, as per guidance note, it is very clear that if section 41 incomes not routed through P&L account should be reported as observations. Further, such amount should be reported even if not routed through P&L account. So this particular clause does not mean that only the amounts which have been credited to P&L only to be reported, or which are not credited which is only to be reported. All the section 41 incomes, whether routed through P&L or not, is required to be reported as part of clause number 25. Tax audit observation, quality review board, to be reported whether credited to P&L account or not. Payments to specified persons, that is related parties in practical parlance, advisable to maintain relationship with the assessee that how covered up. Friends, it is quite advisable that whatever the persons are being certified as part of 48(2)B, we should know that how that particular, which particular part of clause 42AB is related to the assessee. Friends, under section 48(2)B, it is not required to certify whether the amount paid is unreasonable or not. But we have to certify the amount incurred. That's all. Tax audit observations are there that we must take care of. Amounts mismatch with annual reports, specifically in case of companies. Consolidated figures instead of nature wise. Now, it is quite possible in case of partner, that is covered up by section 48(2)B for the firm. It is quite possible the salary is being paid, interest is being paid, rent is being paid. Friends, all these three figures are to be reported separately and not to be clubbed. Friends, in my personal view, if we follow that particular 60-pager tax audit quality review board observation, the best audit will be done from our side, even if we follow that. So at least go with that. If you want to improve your quality, you can go with the guidance note. Friends, every year, if I talk about our ICI, is doing very hard work in that keeping updated tax audit guidance note. Friends, earlier, if I talk about, used to be like once in a moon tax audit guidance report. Now we are getting tax audit guidance report almost every year. It was there in 2022, if I'm not wrong, then 2023. I think there was not in 2024. Now we have again guidance note in 2025. Now coming to this particular clause number 40, section number 40 read with clause number 21. It talks about you have to report the amounts in respect of which TDS has not been deducted, or after deduction, the TDS has not been deposited on or before due date of ITR. We all know that in case of non-resident, 100% of the expenses is allowed. In case of resident, 30% of the expenses disallowed. The question arises whether reporting of 100% of expense is required specifically in this case, or only the disallowable. In my opinion, only the disallowable amount is required to be reported. Friends, this is generated this particular view. I have tried to derive, not expressly written, in the tax audit quality review board observation. Language suggests that amount admissible need to be reported. Friends, one aspect, you just tell me. Now, I made a particular payment in May 2024 on which no TDS was deducted. Obviously, this will part of clause number 21. The amount, the TDS which has not been deducted. Now it is quite possible that the assessee obtains, if I'm not wrong, that is form number 26A under proviso to section 201. That simply says that if the deductee or the payee has accounted for the amount on which I have not deducted TDS in his revenue, has reported as income, filed a return of income, and the taxes which are due as per that return of income has been paid, and to that extent a certificate is provided by the chartered accountant, it will be deemed that the assessee has deducted and deposited the TDS. And in that case, only the assessee has to incur interest expense. There will be no penalty at all. The question arises whether this will result into 30% disallowance or not. Friend, this question is arising because of the language provided as part of proviso to section 40. It says that it shall be deemed that the assessee has deducted and deposited the TDS on the date on which the return of income has been filed by the payee. Now, for example, payee filed the return of income on 31st of July 25. Now, it will be deemed that I have deducted and deposited both the things on 31st of July. Friends, even if in case the TDS is deducted on 1st of April and deposited on 2nd of April, expense is not allowable. The due date of ITR has relevance only in case when TDS has been deducted on or before 31st of March. So my view is that in case of 30% expense would be disallowed. But there is a corollary, if I talk about, there is a corresponding counter, if I can say, that when you are charging interest from the deductor, then how can you say that it will be disallowed also? Friend, this will result into indirectly double interest, because if there is a 30% disallowance, corresponding income will increase and he has to pay advance tax or interest or because of shortfall in advance tax, and you are charging interest over the TDS also. So that's a disputed matter in my view. So that question arises in case the assessee has obtained form number 26A, whether it is required to be reported or not. Friends, if you are taking a view that this 30% expense is not disallowable, then in clause number 21 it is not required to be certified. But in any case, you have to take care of clause number 34, in which amounts in relation to TDS has to be provided. Depreciation, this is a major observation of tax audit quality review board, which I have seen also, that in case of date of purchase, put to use or sale, the persons are providing reported same or two dates. Friends, how it is possible that every asset is put to use on the date on which it is acquired only? Further, friends, all the assets are divided into two dates, that is generally either 30th of September or 2nd or 3rd of October and 31st of March. Just to give the impression that on these assets the depreciation is allowable half and full. Friends, if we are certifying this, we are doing blunders. Friends, in selected assets, it is possible that date of purchase and put to use may be same. But for all assets, it cannot be possible that date of purchase and put to use are same. So that we have to take due care. Quantitative details, clause number 35, by trader as well as manufacturer. If the person is manufacturer as well as trader, in my opinion, only clause B need to be full, as it includes trading also. Friends, we should obtain a certificate or MRL from the assessee in this respect. In case of multiple items, we all know that constituting 10% of purchases or consumption or turnover is required to be reported. And friends, in that case, we should have the stock statements provided to the bankers in case loan is there. We all know that the stock statement is required to be banks in case of credit limits depending upon the stock. So we should obtain that and we should check out whether any kind of differences are there or not. We should have a reconciliations thereof. Registration numbers, indirect tax law, not technical, previous year, assessment year, nature of business or profession, books of accounts. Friends, I'm ignoring these things. If you have any particular query, most welcome to ask, considering the time constraints we have. Method of accounting. Friends, in this respect, I want to address only one part. That in case, for example, assessee was under presumptive succession like 44 AD in assessment year 24-25. 25-26 normal provisions are there. Whether it will be called change in method of accounting? No, because as there was no books of accounts last year. In that case, we have to comment as not applicable with reasons thereof. In that case, only thing is required which maybe we have to account for whether the last year when presumptive was followed, whether turnover was calculated on accrual basis or cash basis. Similarly, in case there is a first year of business, there is no change in method of accounting. So we have to comment not applicable in that case. Status 5629, GAR not applicable at large. Friends, with this, would like to conclude and would like to thanks, may not be able to get the opportunity, to the tax audit quality review board along with Anu sir, Pankaj sir and the whole team for providing this particular opportunity. And friends, we can shift towards the Q&K section. If there would be a limited question and answers, we will come back to the any clauses which the participants may expect to discuss.
Sir, we have shared the questions with you, but Neha ma'am will take question one by one and you can answer.
Okay. Can we start with the questions then?
Neha ma'am, can we start with the questions?
Yeah, sure.
Yeah.
Sorry, the mic was not working. So we were questioned whether the recent changes in clause 22 dealing with disclosure of delayed payment to MSME requires reporting only for the amount payable as on 31st March or for all the delays within the reporting financial year.
Okay. Friends, you must be appreciating this particular question. That in clause number 22, there are three clauses. We know that clause number 22, Roman 1. In that case, only interest to receive reported. Then we have clause number 22, Roman 2. And then Roman 3, again, two parts, A or B. Now, question is regarding whether all delays in payment for which that clause number 43BH is applicable or covered up by 43BH. Not emphasize applicable, the covered up by. That means that payments are required to be made to the micro or small. And if not paid within time, then disallowance may attract. So whether all delays are required to be reported as part of clause number 22 or only which are outstanding as on 31st of March is required to be reported. Friends, that's what we have discussed in clause number 22, Roman 2. The total amount is required to be reported, whether there is any delay or not, whether outstanding as on 31st of March or not. If it is covered up by 43BH, covered up means whether admissible or not, I'm talking about. If would have been delayed, it would have been disallowed. Then 43BH is applicable, covered up by 43BH. That amount is required to be reported as part of clause number 22, Roman 2. So whether delay or not, in case of 22, Roman 2, it is does not matter. Now coming to 22, 3A. What does the 3A says? The amount which is paid within time. That means if there is a delay even by 1 day, whether within the year or after the year, is not part of 22.3. Now coming to 22.3b, that was 22.3a. Coming to 23.3b, that talks about which is inadmissible. So that means if any amount in respect of, for example, May 2024, which was paid in December 2024, although there is a delayed payment, but that is not inadmissible. So it means this is not part of 22.3b even. Now in that case, whether this amount is required to be reported? No. So that gives the interpretation that in case of 22.3b, only the amounts which are outstanding as on 21st of March is required to be reported. And out of this, only that amount which is required to be disallowed. Like, for example, if the liability was incurred on 28th of March and in 15 days I was supposed to pay, that was 12th of April. If I made the payment on 12th of April or before that, this amount will not form part of 22(3)(b. But if I made the payment after 13th of April, after 12th of April, that is 13th April or later, now this will become part of 22(3)(b.
So the next question is, under which clause provision for doubtful debt to be reported?
Friends, in my opinion, provision for doubtful debts is not required to be reported as part of Form 3CD. If I remember, if I'm able to recall all the clauses, the one clause which may be applicable, we can say that maybe have a link or little bit, you can say the touch upon this particular provision, that may be contingent liabilities. Friends, in case of contingent liabilities, only those contingent liabilities are required to be reported which are debited to P&L account. The contingent liabilities which are part of notes to P&L account are not required to be reported. Now, the question arises whether provision for doubtful debts is a contingent liability. In my opinion, no. That is on some basis of some scientific analysis. So, in my opinion, provision for doubtful debts is not required to be reported as part of Form 3CD, but it is disallowable by virtue of Section 36(2)(7). Please remember that.
Is clause 34A for manufacturing concern?
34, if I'm not wrong, just let me check out. 34 is A is in respect of, I think, the TDS related matters. 34A, clause number 34. Deduction or collection of tax is number 301. Friends, clause number 34, if I talk about whether the assessee is required to furnish the statement of tax deducted or tax collected, if yes, please furnish the details. Whether the assessee is liable to pay interest under section 2011A, or whether the 34A is whether the assessee is required to deduct or collect tax as per the provision of chapter 17B. I think this is applicable for all type of assessees, whether it is manufacturing or trading or professionals or service provider, whomsoever. If the TDS was required to be deducted during the previous year, I think 34A is applicable.
So the next question is, how to deal the clause 15, 45 days of payment?
Deal with clause 15 or 45 days payment. Friends, I'm not able to get what you want to ask. Actually, friends, we have to check out on the basis of the MSMED Act when 15 days is applicable, when 45 days is applicable. In case of written agreements, we know that clause of that period of 45 days is provided. If there is no written agreement, then the period is 15 days. Written agreement or written document may include the bills also, in which it is stated that you have to make payment in these particular days, but there is no kind of communication whether through bills or written or mails. In that case, in my opinion, the 15 days conditions will apply. Whereas in respect of clause number 22, I will address you one thing, that how to determine which entities are covered up by MSMED Act, specifically for 43BH. That is the question of the day. Friends, in any case, it is responsibility of the assessee. Please remember, it is responsibility of the assessee to identify the suppliers who are covered up by 43BH. For that, he has to do the exercise. In case there is no exercise by the assessee at all, in my opinion, we should provide kind of that qualified opinion in that case. Friends, please remember, this is not impacting books of accounts. So there will be no rejection of books of accounts on account of that particular aspect, whether the assessee is maintaining records of MSME or not. Madam, I will take 1 or 2 more minutes in this particular aspect. So friends, ask the assessees to send the mails or the letters to all the suppliers, maintain the replies received, and we should have on sample basis those particular mails and those particular replies received. On the basis of the reply, the list have to be identified, which assessees are covered up by that particular 43BH. Friends, alternatively, there could be an option in my view, if the assessee has not made such efforts, in that case, as an auditor, we may have to send the letters to all the suppliers. And considering today is 16th of September, I do not think so. As an auditor, we have such a sufficient time to send the emails or to send the letters to all the suppliers and wait for the responses. Yep. Yes, please.
So clause 44 is mandatory or can be avoided by proper notes.
Clause 44. Clause 44 is mandatory. If you are certifying that clause 44 is like, for example, kept blank, and we are certifying the necessary records are not being maintained or whatever, friends, in my opinion, in that case, the assess's books may be rejected. When proper records are not there, how we are certifying the other clauses at all? Friends, this could be applicable only in case when the GST is not applicable for that assessee. For example, if I talk about the advocates, now GST is not applicable. It is quite possible they are not maintaining records in such a way that GST is reported separately in the books of accounts maintained. In such circumstances, in my opinion, it is permissible, otherwise not. So friends, proper note, I do not think so, will suffice the purpose at all. Friends, educate the assessees that how to maintain the books of accounts is a one-time hard work if I talk about. And if you're advising the assessee that how to maintain the books of account, this is another aspect of the professional services which we can render to the assessees. Friends, I say it to be income tax health checkup. I provide this kind of services to my assessees. That whatever records you are maintaining, I am going to check out whether it would be sufficient from the perspective of income tax department assessments or not. And friends, it's such kind of services you provide. I think the assessee will learn the things, assessee is going to maintain the things, and that will be beneficial for the assessee in the long run itself. And I've seen that particular aspects. 90% of the things are available whenever the assessment is there. No hard work is required at that time, and the assessee feels happy in that case. Yes, ma'am.
Whether invoices raised in March 2024 to micro or small enterprise which become due for payment in financial year 24-25 shall become part of clause 22 second. It seems that it would also be covered since it is the amount which is required to be paid to micro or small enterprise during the financial year 24-25.
Okay. Friends, I am repeating this particular query with a small example so that every can appreciate what is being asked. There was an amount expenditure which was incurred in the month of March 2024, the last financial year I'm talking about. But as per MSMED Act, which was required to be paid in the month of April 2024. April 2024. Now the question arises whether this particular amount is required to be reported as part of section clause number 22 Roman 2, which says total income amount required to be paid during the financial year. Friends, there are two views in this particular aspect. In my view, it is not forming part of the books of accounts, or you can say the P&L account, which is I am being checking, I am certifying. A logical view, if we go by, the only the amounts which have been incurred during the financial year 24-25 is required to be reported. But if we go by the technically this particular language, the word paid, it something symbolizes nahi. That should be included. In my view, if I follow that my intuition or my interpretation of law or my reading of the law, so in my opinion, this particular example is should not form part of clause number 22 Roman 2. Yes, ma'am.
So, any amount payable to MSME for financial year 23-24 is still not paid till August 25, but disallowed in financial year 23-24. Then how to report the same? Do we need to report the same or not?
Okay. Friends, if any amount is in relation to financial year 23-24, which was disallowed in financial year 23-24 under clause 40, under section 43 BH, is required to be reported in tax audit for assessment year 25-26, although it is not paid even as on date. But as part of, if we remember, we discussed 26 capital A. 26 capital A says any amount 43B A to H, which was disallowed in prior years, which was paid during the previous year or not paid. So this amount will come as part of 26 capital A part 2, that it was disallowed in prior year and even not paid during the previous year. So it is required to be reported.
Under, under clause 31 A2 basis the answer to the question whether the loan or deposit was taken or accepted by check or bank draft or use of electronic clearing system through a bank account. A drop box with various options is available in Form 3CD e-utility. In such case, is it mandatory to provide the relevant code for each and every loan or deposit transaction during the year?
Okay, that is quite interesting question. I'm just elaborating this particular query. The participant is asking, like for example, I took a loan. I'm assuming that I'm liable for tax audit and whatever the things. I took a loan from Mr. A and in parts during the year. First part I received through, like you can say, the account pay check. Second part maybe through NEFT, that is electronic clearing system. So in that case, whether in clause number 31, that is in respect of 269 double S, whether both these transactions from a single person is required to be reported separately. If I go by the intent of this particular form 3CD and utility makers, yes. Because when it is talking about that mode of acceptance of that loan, and in that various options are there, that is required. It is quite possible that I may have to report a particular lender of 5 times in clause number 31. Yes, ma'am.
If payment on which TDS is liable to be deducted become due to MSME vendor but not paid within the time allowed under Section 15 of MSME Act 2006 and also no TDS is deducted at the time of accrual, in that case, whether disallowance is to be 30%, 100% of such expense or 130% of such expense. Please advise.
Okay, that is quite interesting question. And that is very good question if I talk about. Like for example, I'm liable to pay a particular person rupees 100. And that person is covered up by 43BH MSMAD Act. And I'm supposed to deduct 10 rupees TDS on that. I made the payment of rupees 90. First example I'm taking, then I'll go to another example. And I deducted rupees 10 as TDS, but was not deposited by me. Now, in that case, the disallowance by virtue of 43BH will be there of rupees 10, or there will be disallowance under section 40AI of rupees 30, or there will be both the disallowances. In my opinion, in that case, when you have deducted the TDS, it is no more payable to the supplier. It is payable to the government. The nature changes. Effectively, you have made the payment to the supplier of rupees 100. So in that case, in my opinion, section 40 will apply and rupees 30, that is 30% of rupees 100 will be disallowed. There is nothing is required to be reported as part of 43BS, that is clause number 22 or 26A, whatever. As part of clause whatever TDS is related is there, that is required to be reported. Another case, that I did not deducted that rupees 10 at all, but I made the payment to the supplier, or elaborating the example, and even payment has not been made to the supplier. Now both the things are there. There is a disallowance by virtue of 43BH also, because no payment has been made to the supplier, and further no TDS has been deducted and deposited with the government. Now the question arises whether there will be disallowance of rupees 100 under section 43BH, or disallowance of rupees 30 under section 40 clause AIA, or there will be disallowance of rupees 130. Friends, in any case, disallowances cannot be more than the expenditure incurred. In any case, disallowance will be restricted to rupees 100 only, whatever the case may be. Now, as part of reporting, in my opinion, both the places this amount should be reported as part of section 40 clause A, that is 30 rupees, as part of clause number 22, that is 100 rupees, but suitable description must be there that this amount is reported twice. Friend, this may result into the problem with the SSC, frankly talking out about. In that case, you can take approach, or SSC can take an approach, and we have to certify that he disallows rupees 100 only, whether 30 plus 70 or 100 as the case may be, and we can give a suitable observations that for the purpose of clause number 22 or for the purpose of clause number 31, we have taken those amounts only which are otherwise allowable as per other provisions of the act, so that there is no double reporting of a single amount. In any case, disallowance will be restricted to rupees 100 only. Yes, ma'am.
During the first year of proprietary business, the limit is exceeded of section 44 EB. That is turnover 11 crore. Does TDS is applicable?
Friends, no. If I talk about individual HUF, we all know that the TDS is required to be deducted only if the turnover for the preceding previous year exceeds rupees 1 crore or 50 lakhs, as the case may be. In my opinion, in the first year of business, in case of individual HUF, TDS is not required to be deducted in those sections in which tax audit or something reference of turnover is there. Obviously, salary deductions will be there. That is irrespective of whatever the turnover was there. So that we have to take care. And second thing I would like to highlight, it is not dependent upon tax audit. Please remember, this amendment has been made very long back that TDS is required to be deducted in case in preceding financial year turnover was more than 1 CR or 50 lakhs, as the case may be, whether audit was there or not. Like for example, I'm professional. In preceding financial year, my receipts was rupees 60 lakh. I was following presumptive income under section 44 AD. Friends, no tax audit was there. But in current year, I'm supposed to deduct TDS because in preceding financial year, my gross receipts were more than 50 lakhs.
15 number छोड़ देना हो.
हाँ जी मैम.
In clause 23, transaction with a specified person. So whether fellow subsidiary shall be considered as specified person as per section 40A2.
Friends, for
And
that
with-
purpose, we need to like analyze word by word that fellow subsidiary is a related concern or not. If I'm apparently able to recall section 40 capital A clause 2B, I think fellow subsidiary is a that related party. As far as I'm reviewable, I'm making a disclaimer. For that purpose, we need to clause by clause. That will take time. Friends, you have my number also and email ID. If you want to ask anything, most welcome to call at any time. I will try my best to provide you the resolution of your queries. You can send me the mail also, but please write down your mobile number in the email. I will just share again so that anyone wants to know can note down. Yes, ma'am, please.
Clause 22, client has provided the net amount payable to vendor for each transactions during the year, but does not able to provide the base amount of purchase during the year. How should we disclose in such case?
Friends, you have to go by the books of accounts. The client has provided net amount payable. I am not able to apprehend. Whenever we have access to the books of accounts, audit is possible only if you go through the books of accounts. From that, obviously, it can be derived that the gross amount which was payable to the vendor. So I do not think so, friends. With the limited information provided by the assessee, we can go for the audits at all.
So next we have clause 13 ICDS referring circular number 10 2017 as well. Talks about mark to mark losses and gains. Will unrealized gain arising due to fair value changes of investment in mutual fund be considered under the scope of ICDS? 1. Since ICDS deals with PGBP and IFOS and not capital gain.
Friends, that's the well research you have made and you provided the answer itself. Friends, ICDS are applicable, very true applicable only for the business profits and the other sources. If the mutual funds are held as investment, so whatever the unrealized gains or losses are there, whether you have to mark to market or not, as per statutory audit accounting standards or Ind AS, is not required to be reported as part of ICDS. It is very clear. If the investments are held as capital asset, it is not part of ICDS at all.
So these are the questions we were having.
Okay.
So yeah. So
yeah, please.
On the behalf of Taxation Audit Quality Review Board, I extend my sincere thanks to our speakers for their valuable insight and to all the participants for their active engagement. We truly appreciate your time and looking forward to your continued participation in our future programs. Thank you so very much. Thank you, sir.
Thank you, ma'am. Thank you very much.
Thank you, sir. Thanks for the excellent presentation, and your deliberations are really very well.
Thank you, ma'am. Thank you. Thanks for the appreciation.
Thank you,
Thanks
sir.
to the participants specifically. That means a
Yes,
lot.
sir. Yes, sir. And we surely look forward for more such webinars. with you.
Definitely. For professional, I'm always available.
Yeah, thanks a lot, sir.
Thank you.